Good evening, everyone, and welcome to the call. Uh, Today, we're going to talk about our upcoming NFO at Axis Mutual Fund. Uh, this is called the Axis Global Equity Alpha Fund, which is the NFO for which will start on the 4th of September. Today, with us to discuss the product, we have Chandresh Nigam, the CEO at Axis Mutual Fund. Ashwin Patni, Head of Products and Alternatives. And from the Schroders team, we've got Gavin Marriott, Investment Director of Global Products. Uh, Chandresh, would you like to make a few opening remarks?
Yeah, thank you, Shane, and good afternoon, everyone. So happy that all of you could join this call. This is something we're very, very excited about, the launch of the Axis Global Equity Alpha Fund of Fund, our first 100% international exposure fund. Many of you may know that we've done a couple of other products with international exposure, but this is the first product where 100% of the fund money will be deployed in global markets. Before we get into the process and Gavin gives us details on how the fund is run by Schroders, I just want to give a brief background on why we are doing this product. Now, many of you, obviously, who you have been in touch with us, know our investing style. At the end of the day, we along with you, our partners, want to provide really great investment experience to our customers. And when we talk about investing in equities, we talk about creating wealth from a medium to long-term perspective. Now, if we just stand back and look at the environment, the emerging environment over the last 5 to 10 years, 10 years back when Axis AMC really started operations, we were looking at the overall environment and saying, if you people remember, that this was just after the global financial crisis, the economy was really recovering very solidly, 2009, 10, 11, double-digit GDP growth. And we said that there are a large number of very great companies in India, growing at anywhere between 18 to 20%. In fact, Nifty earnings used to be higher than 20% compounded. And we said that there are great opportunities in India. With the very high growth rate in the emerging markets, and especially in India, we really did not feel the need to take our investors global, to make them invest in global markets, which has been the experience for many of the other emerging markets. So one talks about, let's say, Southeast Asia. People have been used to investing globally, partly because they may not have been great investment opportunities locally, and also because the education and the awareness which comes in trying to reduce risk in client portfolios and the benefits of diversification. So all those things actually worked in favor of local markets, I would say 2011, 12, and I think that continued for the next 4 or 5 years. So even while as the economy has been slowing down from that 10%, we are now at around 5%. Hopefully we will go back to 6 and 7 and maybe even higher. The number of companies which we can really classify as high growth companies in India has come down. So just to give you an example, when we started business 10 years ago, our investment universe, and as you all know, we are high quality growth stock investors. Our universe was about 350 companies. Today, looking at the environment, it's down to about 200. Now, 200 is still a very large number. I mean, we are really blessed to have a large number of high quality growth businesses. And these businesses will continue to grow at maybe the 15, 20%, and some of them obviously more than the 20%. But definitely, the overall universe has shrunk. Secondly, as I said, the GDP growth is no longer in that 10% kind of range. It doesn't look like it's going there in the next 2 to 3 years at least. And hence, there is importance to seek out higher growth businesses. Now, some of them do exist in India. Some of the sectors which are growing much faster than the economy, especially led to technology and some startup kind of businesses and people who have been companies which have been largely funded by private equity. Many of these companies are now owned by global majors. So those opportunities to play in the high growth space within the Indian economy is virtually not there. Some of them may over a period of time get listed, but right now they are in the unlisted space, and we don't have an opportunity to exploit opportunities in that space within the country. Well, on the other side, uh, looking at the environment where globally we have seen large number of companies actually use technology and differentiated business models, disruption, and stuff which Gavin will talk about. We're seeing many companies actually really upping the growth momentum in their businesses. So like we've seen in India and we are seeing in India, there are many companies globally also having significantly high growth rates. And obviously they are not listed. So from all perspectives, it makes sense to get our investors' portfolio, have exposure to these great quality uh, growing companies, take advantage of the opportunities available globally. One, to, as I said, play the big companies whose products and services we are all very well aware of, but we can't take exposure. And secondly, to diversify. In a slow growth environment, there is obviously higher risk to longer term growth. And while again, I reiterate, I think India is a great market. We are all blessed to have great businesses. I think it makes sense to, in a limited way, get our investors focused on global markets as well. So in that light, we are very happy to launch the Global Equity Alpha Fund. Actually, 2 years back or 3 years back is when we really decided that we need to provide opportunities to Indian investors to invest abroad. We did it in two products in a hybrid manner. So we have the Axis Global Opportunities Fund, which invests about 65 to 70% in Indian markets to take care of the taxation structure in India, and 30% was invested in global stocks, which kind of mimics the Global Equity Alpha Fund of Schroders, into which this new fund anyway is going to feed into. And this fund's done very well. And lately, about 6 months back, we did the Axis ESG Fund. Again, 30% of it was earmarked for international investing. And again, Schroders has been advising us to invest in that bucket. And while it has a short history, that's another fund which has been doing fairly well. So we're very excited now to get a product which is going to be 100% invested in the global markets. It's not a product which goes only into the US, though US is a large part of it, but it takes into, is able to exploit opportunities all over the world. And that's something which Gavin will take us through on the investment strategy and how the fund is done. So thank you all very much for joining in. It is, I think, this certainly is our first international product in the true sense, and you can probably do more. But I think the message is clear from our side that we do want investors to exploit global opportunities, and we need funds like these to be able to tap these opportunities. So I will stop here, hand it back to Shane. Shane, can you take the call forward, please?
Yeah. Thanks, Chandresh. Thanks for that overview. Now to deep dive into the product, we've got Ashwin, who's the head of products and alternatives at Axis Mutual Fund. Ashwin, over to you.
Thanks, Shane. And hello and good evening, everyone. And thank you for joining us today. And what we'll do over the next half an hour, 40 minutes is take you through this presentation where we will talk about what this fund is about and also about what the why investors should look at global investing and what are the benefits. So let's start off. So if you look at, the first really thing to note when you look at equity investing and you take a step back, because whenever we talk about equity investing historically, we've always seen it with the lens of equity investing in the Indian markets. But if you take a step back, equity markets are not limited to India. Most major countries, if not all major countries in the world, have equity markets. Most of the major companies worldwide, a lot of them are listed and traded in some of the other large stock market. So whatever we talk about in terms of equity investing, it's true not just of the Indian markets, but actually it's a broader truth, that is that we have to see from a global perspective. And in that context, if we take a step back, it's very, very sort of eye-opening to note that our entire, experience of equity investing, which has been largely limited to India, is such a tiny part of the global ecosystem. This is a shocking number, when we see it also, anyone who sees it for the first time, India is just 3% of the global market cap. Essentially, therefore, there are large, massive markets out there, China, Europe, the UK, of course, US, we all know, massive, large liquid markets, which have lots of large liquid companies which are traded in those markets. And, and when we talk about, equity opportunities, and as Chandresh just mentioned, essentially what we're talking about is capturing some of these ideas from the other markets as well. If you look at, moving on, if you look at, even from another perspective, if you look at when we as a consumer, when we buy any product, today it's a day and age of a globally interlinked world. It really doesn't matter where some company is headquartered or where it is manufactured. It is still able to tap into global markets, just like a phone maker or a car maker. In India, a lot of global companies are active. We are able to buy global products in our consumption basket. They form a big part of our consumption basket. Just like that, even in investments, ultimately, we have to broaden our horizons, and we have to start recognizing that the opportunities don't have to be limited only to Indian companies, but actually to companies from wherever they are based on their growth opportunities. If you look at moving on, if you look at the data, it's actually quite a striking data, and I'm referring to the table on the left. This is just the column in terms of the called investment in home market. Essentially, what we have said is that what is the percentage of total investor portfolio that is allocated to their own country in each of these markets. So, for example, for an American investor or US-based investor, out of every 100 rupees or $100 that they may be investing into equities, 79 of that goes into their own market. But that's the interesting thing, that even for a large liquid market like the US, 21% of the money is going outside of US for other opportunities. If you contrast that with the data that we have for India, practically and anecdotally, all of us will know about this. Practically 100% of our investor portfolios is completely into domestic markets. So essentially, we're completely missing out on the entire wider global opportunities that are out there. Another way of representing that size of that opportunity is one on the right. Just three large stocks, Apple, Microsoft, and Amazon, today have a size which is combined bigger than the size of the entire Indian equity market. So there's just another way of looking at the same data. So why should we look at global investing, or what are the advantages? Let's move on to the next slide. We have three big points that we would like to highlight. The first, and really the core point, is the fact that by broadening our investment horizon or investment universe, like Chandresh mentioned, we get ourselves exposed to growth and opportunities which are available in other markets and don't limit ourselves only to India. The second and third points, which are slightly interlinked, which is essentially from a portfolio perspective, as many of you would have heard the saying, don't put all your eggs in one basket. When you put your eggs in multiple baskets, when you allocate money into multiple geographies, essentially the benefit that you get is that of a diversification that brings down risk for the portfolio, and as a result improves the risk-adjusted return for the portfolio. So that's the benefit of global investing. Let's take these one by one. The first, as I mentioned, and the most important one, is exposure to growth. And Chandresh has already sort of covered that in a couple of minutes in his opening remarks. But I would reiterate that if you look at our daily consumption basket today, if you look at the kind of time, money that we are spending, a lot of these type of new age opportunities are not available to us in the listed market. Classical example is an e-commerce stock like Amazon, or a consumer or an internet stock like Google. These are not, which is known as Alphabet, these are not really available to us when we look at the Indian listed markets, because some of the big sectors and themes in the Indian markets which are there, that these type of themes are not really available. While we may have companies in India, they are still unlisted. So if we are allocated to the Indian equity markets, we are missing out on these growth themes. What are the power of these themes? If we look at the next slide, some of these stocks, and these are just just a very, very small set of stocks that we just took for way of illustration. Just as a, and there is a mixed basket. As you can see, there are software makers like Adobe, there are internet companies like Alibaba and Alphabet, there is a consumer company like Adidas. The common thing that you find in all these ones is that each of these companies over the last 5 years has been able to compound or grow its earnings at a very, very reasonable level. And they're all very, very large companies when you look at their market cap in terms of the total value. So essentially, the two things that we used to like, we always like about the Indian markets, that are large number of opportunities in the Indian market, and we are able to get a lot of growth in the Indian market. Of course, that is true for the Indian market, but our point is that it is not true only of Indian markets, but there are many other ideas out there. Like, this is just a few examples that we put in, but there are many, many companies out there beyond India in the global context, which are also able to offer reasonably high growth prospects. Moving ahead to the second point that we made, which is the point about risk, and then related point about risk-adjusted return. Risk can be measured in a number of ways. We all know that when you invest in equities, equities are a risky asset class, so we have to be prepared for an ups and downs, which is part of the journey, which will always be there. But at the same time, all equity markets don't have the same level of risk. India, as we all know, is seen as an emerging market in the global context, and typically these type of markets have what is called higher beta or higher volatility. Some of the developed markets like the US or similar markets in Europe, etc., are more developed in nature and actually have much lower volatility than India. On the next page, we also have plotted the correlations. Now, correlation is nothing but how much these different markets move with each other, or how much they move differently from each other. I'll just give a very simple example to look at correlation. Just look at the current year, which has been, obviously the year has been completely taken over by the entire COVID situation. And what we've seen is that if you look at the calendar year 2020 so far, you see very different reaction from different markets. Of course, India and some of the big developed markets, we all saw a large correction in March. But subsequently, what we saw is the market like a US was able to rebound very quickly, and indeed has already reached a new all-time high. Whereas a market like India saw some time in coming back, and while we have recovered quite smartly, but we still remain a little off our lows. Contrast this with a market like China, which never really fell in the first place, and indeed continued to do really well all through the months of March, April, while the rest of the global markets were totally disturbed. So that is what we mean by correlation. Now, essentially, if your portfolio has exposure to a number of these markets, all these markets don't have to react in the same manner whenever there is some event or whenever on a day-to-day basis. And that's where the diversification, the classical sort, like I said, not putting all eggs in one basket, really brings down the risk. Moving ahead, combine the risk part with the return part. Now, this is a busy chart, but what we have tried to bring out, and the color scheme will tell you, is the green colors is for any year is a market that has given very good returns for that year, and the red color is the the market which is not given, or is given poor returns in that year on a relative basis. what you find is that the green colors are not constantly only in one market. India has seen many greens, but so has the US, surprisingly Japan, which we don't think of as a high growth market. China has seen lots of greens in recent years. So therefore, what we find is that the green keeps shifting. And the interesting thing is the first column, which is the world, which is a sort of a composite. And what you find is that it tends to be quite stable and does reasonably well because it's able to allocate across, it has got allocation from across the other markets. So if you combine these things, which is lower risk that you get from broadening the horizon, the impact of correlation, and the fact that different markets do well in different years, what you get is the impact on the risk-adjusted return that we were talking about. Let's look at that table. Uh, I'm referring to the table on the left on this slide. What we have done really is to filter out that entire study of last few slides into a very, very simple table. What it does is on the first row, it talks about what is a domestic portfolio, essentially through, say, a Nifty 50 index. The second row is what about a global portfolio through an index like a MSCI World. And third is a composite if you combine the two in a particular proportion. For our illustration, we have shown a mix of 70% into domestic and 30% into global. What you find is that India has done well. The first row has done well in the return category in the last 10 years compared to the world. So that's something that is in line with what we expect. The second and third columns also show that India is a little bit more risky than the global markets. And that is also not a surprise. We already discussed that that is the case. But the most interesting thing is in the third row, which is when you combine an allocation across both these markets, what you get is a dramatic improvement in the risk-adjusted return. And that is really, why is that happening? That is happening because of the beauty of diversification. I would like to reiterate, this is just an illustration that we have taken, which is 70-30. We don't believe that there is a right answer. What is the correct allocation to the global portfolio can be something that every investor and advisor can decide on their own. But it is our belief that even a small allocation to global stocks can still allow you to participate in this risk-adjusted return journey, which you get by diversification. The other part about diversification is also what the global portfolios are able to do from a currency perspective, which is on the next page. What we find is that, as you know, in India, when we are allocated to all Indian asset classes, we don't really have to think about currency at all. But obviously, when we go beyond India and we allocate to global markets, we will have to start thinking about what the different markets or the currency movements are doing to our returns. And as you can imagine, one of the things that we have seen over the last 15, 20 years or even longer is that because of the particular macro structure of the Indian economy, where we have current account deficits, where we have slightly higher inflation compared to the rest of the world, there is a tendency of the rupee to depreciate on a steady basis. While it may not happen in a straight line, but if you take a slightly longer horizon, typically we do see some steady depreciation. So to that extent, when you invest in global assets, your total return in rupees does get pumped up by the currency impact as well. So with that I will just summarize the first part of the presentation, which is why to look at global investing. We mentioned that India has done really well, and that is not likely to change because the country has a very long growth path ahead. But at the same time, we have to recognize that India is still a reasonably small part of the global opportunity set. So as we get more and more, mature as equity investors, we have to start becoming more aware of the opportunities around us, and where the global allocations really play a very strong. We also said that global allocations are important because they also give us access to opportunities that you don't get in India. So talking about this fund, which is there on the next one to talk about, is essentially a feeder fund, what is called the fund of fund structure. What we have here is essentially we have tied up with Schroders, and we have Gavin here from Schroders who's going to talk about the Schroders Global Equity Alpha. That's the name of the fund that we tied up with. and the Axis fund of fund is essentially going to invest into that fund. So the Indian investor, when they come into our fund of the money that we get from that money used to buy units of the fund of fund, the entire process will work very similar to how any investment you make in any other local equity fund as well. That's the beauty of this fund of. So with that, on the next page, we have, from this page onwards, we will talk about Schroders and also about the Global Equity Alpha, the strategy that Schroders manages. And I will request Gavin to take over the presentation from here and talk about, first, of course, introduce Schroders for the audience today, and then talk about the fund in question as well. Over to you, Gavin.
Ashwin, thank you very much, and good evening, everybody. I'm really thrilled to be speaking with you today, and thank you for sparing the time. I wanted to start just by saying how excited we are to be part of this fund launch, and we have enjoyed a long-standing relationship with Access Asset Management, which we value greatly. They are strong long-term partners, and the India markets important elements of Schroders' business, and it's that bit of the business that I work within and represent. As a business, we have a global footprint. We operate in more than 37 geographies, but we manage money from over 20 geographies where we have local analysts on the ground, meeting with company management and providing research input. And that provides a very, very important base for when we are managing global equities. Shane, if you can perhaps go to page 17 of the document.
Sure.
Thank you very much. As Chandrish and Ashwin have already mentioned, global investing is a rich source of opportunity, but it is also a very complex asset class with many, many opportunities in different geographies and across different sectors and industries. Our investment opportunity set is over 5,000 companies, and what we are trying to do for this fund is narrow those opportunities down from 5,000 to something in the order of 40 to 50 stocks that we believe represent the best risk-adjusted return source for this particular fund. To do that, we are making use of that large global footprint that I mentioned that Schroders has. That means to us speaking regularly with over 100 equity analysts around the world and more than 25 credit analysts, and using their research as the starting point for our further analysis and stock selection process. What we are doing within that is we are trying to identify the best possible investments for this fund, and we believe there are 5 key components that give us an edge relative to the market in order to do so. And those are shown on this graphic in front of you. The first one is philosophy, and I will spend a bit of time in a few minutes explaining the philosophy of the team. The second one is that research footprint that we have already mentioned, so those 100 equity research analysts. But in addition, Schroders has invested heavily in a big data science team. This is a team of data scientists that sit alongside the equity analysts and investors and provide investment insight based on unstructured data, so non-traditional data that we can increasingly use to provide an insight on the investments that we make. That data science is typically digital data, so it comes from social media, it comes from other open sources of data, but it's really a very important tool for us in a way that we manipulate a very large source of data to try to find useful investment pointers. The third differentiating area is in terms of stock selection, and what we do there, as well as trying to identify companies that are going to grow rapidly and deliver significant share price outperformance, we do that in a way that we are thinking about the non-financial attributes of companies when we think about the risk-adjusted return potential of these stocks that we invest in. From a portfolio construction perspective, Ashwin has spoken about the benefits of bringing international exposure alongside domestic exposure. And that's very much the guiding principle when we think about portfolio construction for this fund. What we are trying to do is ensure that we get the best trade-off in terms of return for the risks that we take within the fund. Any investment involves risk, but of course what we want to do is get the biggest possible return for every unit of risk that we take for you as investors. And we have very complex systems that allow us to understand the drivers of risk and therefore return within our portfolios. And finally, the final point of differentiation, I think as a business, Schroders are committed to sustainable long-term investment. The structure of Schroders' business is long-term, and therefore we want to think about investing in companies where there is a long-term relationship, where we can try to shape the way those businesses operate, particularly in terms of the environment and social impact those companies have. So a very important aspect of what we do is focus on engagement with the management of companies that we invest in to try to improve not only their financial returns, but also to improve their non-financial performance, their impact on society, the environment, and stakeholders more broadly. So when you think about Schroders, think about those 5 areas as the key elements to what we are trying to do for you and for you as a potential investor in this fund. Shane, thank you. If you can maybe flick to page 20. I just wanted to spend a bit of time outlining the philosophy of the fund. And it's not only what we do in terms of our research that helps us to identify stocks that will outperform, but it is also the fact that the market today, despite all the data that is readily available, continues to be very, very inefficient. I have been in this industry managing money in various forms for the last 30 years, and the global equity market today is as inefficient as it was 30 years or so ago. Those inefficiencies come in 3 areas, and the 3 bullet points at the top of that page really just summarize the inefficiencies. First of all, that markets tend to be short-term focused. if you think about the value of a company, actually a lot of the value of the company is based on its long-term cash flows over the next 3, 5, 10, 15, 20 years and beyond. But the market still focuses on cash flows over the next 12 to 15 months. And that introduces an opportunity that we can exploit. The second inefficiency is that markets tend to be backward looking. They look at a company and they look at a company's historic rate of growth, and they assume that that rate of growth will be carried forward on a forward-looking basis. But we believe that there are structural changes in the economy and the markets which will change a company's rate of expected return that the market is not good at understanding or modeling. So that is another form of inefficiency. And the third area is that the markets tend to overreact to short-term news flow. The COVID crisis is a good example of that, where you saw an immediate response to the valuation of companies based on concerns about the short-term impact of the coronavirus on the operating performance of some industries and companies. For sure, it's a challenging time, but we will get through that. And those companies that are correctly financed and managed well will recover. And therefore, the valuation impairment at the nadir of the crisis really represented an opportunity to build positions in some of those stocks. So those are the three market inefficiencies that we are looking to exploit within the approach. Jane, if you can go to the next slide, please. What we are essentially doing within this fund is we are building a portfolio of between 40 and 50 stocks, as I described. Those stocks can be segmented into two distinct buckets. The first bucket on the left-hand side are companies that we believe have the potential to grow their earnings over the next 3, 5, 10 years at a rate significantly higher than is currently expected by the market. And again, Ashwin referenced a number of these companies that have this earnings power that allows them to drive returns consistently over time at a rate way beyond the market's expectations. So the likes of Apple, Google, Alphabet as it is known, Facebook, Amazon, Visa, these are all companies which have continued to surprise the market over multiple years in terms of their growth that they have delivered. And that has been reflected in share price outperformance. Around 60 to 70% of the stocks that we own within the portfolio will be invested in that type of name. On the right-hand side, you see a similar dynamic where we are looking for a profile of forward-looking earnings surprise relative to market expectation, but in this instance, not playing out over multiple years, but playing out over multiple quarters. So a surprise factor in terms of the revenues, cash flows, or profits of a business that becomes apparent over 3, 4, 5 quarters rather than 3, 4, 5 years. Stocks that sit in this category are owned on a tactical basis. We are being opportunistic and we are looking to own those names for a relatively short period of time, potentially 6 to 9 to 12 months until the market recognizes the recovery potential or short-term surprise in earnings that we believe we've identified. So we have two different buckets within the fund. One, a buy and hold approach to these core stocks, these compounding stocks that we want to own for the next 3, 5 years and beyond. And on the right-hand side, stocks that are much more tactical, opportunistic, that we will trade in the portfolio. So that is the approach that we take within the fund. If I take you to page 26, please, Shane. So if you look at the portfolio today, well, actually at the end of June, but it hasn't changed significantly. What I am doing on this chart is showing you the holdings in the fund. What we have done is we have color-coded the holdings so that you have the names that we own based on the assumption that they will grow their earnings over a multi-year time horizon. We have shown those in red. And the more opportunistic names that are owned tactically with a shorter term time horizon are shown in blue. Now, I'm happy to take questions on any of the stocks later when we go to Q&A, and there'll be some very familiar names within the portfolio to you that really reflect some of these well-known names that actually have performed very, very strongly, but we believe can continue to do so and can continue to benefit from significant outperformance. So the likes of Facebook, Microsoft, BMW, these are all names that are well known, well covered, but we believe that the market has misunderstood the forward-looking growth of these businesses. The opportunistic names tend to be in the more cyclical areas of the market where the economic cycle sometimes can impact short-term expectations. So we tend to find a number of those in areas such as industrials, in materials, and in energy, particularly as names that we want to be tactical in terms of our holding. Schneider Electric, probably not a well-known name to you, but is a French industrial company that is heavily exposed to the green revolution and this shift to electrification. They manufacture a lot of power generation management equipment that is increasingly used in factories and in businesses as a way of operating power consumption. So that gives an example of the portfolio today. If I show you the next page just in terms of sector and geography, sector and geography within the fund is driven entirely by the stock selection. So if we find a good stock, whether it be in the US, Europe, or in some of the emerging markets, we will buy that for the fund, and our sector and geographical exposure will change as a consequence. So we're not applying a top-down view, but of course we're thinking about stock opportunities in the context of the macro environment. What you'll see on the left-hand side, though, is a pretty typical profile of sector exposure that we have within the fund. So we are overweight information technology. Some of the areas aligned to that, which would be communication services and consumer discretionary, and overweight some of the industrial companies, because we believe that there is the potential for a strong recovery as we emerge from COVID and we see the impact of some of these huge financing packages that are being introduced as a way of stimulating growth. So these are areas that typically would be overweighted within the portfolio. On the right-hand side, you'll see a significant exposure to North America, that is US and Canada. So the majority of that is the US, somewhere in the region of 65% today. But I could see that coming down quite significantly over the next 12 to 18 months or so as we recycle some of those US names into other areas of the world, principally continental Europe and emerging markets. Interestingly, our exposure to revenues within the portfolio suggests that we only have about 40% exposure to North American revenues. So it suggests that even where we might be owning a US listed company, actually a lot of the revenues of those companies will be sourced overseas in areas such as Asia or emerging markets or Europe. But the important takeaway is the sector and geographical allocation comes from the stocks that we want to own for you in the portfolio. and the stocks that we believe will drive returns through time. I will just maybe touch on one final page to show you how we're currently thinking about opportunities, page 29. And if you look at page 29, what we are trying to do here is show you how we are playing the current market environment. And we have segmented the opportunities into three broad buckets. First of all, where there has been a resilience in the operating and financial performance of those businesses as we have come through and start to emerge from the COVID-19 crisis. A couple of key areas where that resilience is very, very apparent. Areas such as social media and gaming, where the profitability of companies exposed to social media and online gaming have been very, very strong indeed, as people in lockdown have spent much more time on social media platforms and playing online games. So we play that through companies like Facebook, but also companies like Tencent, which is listed in Hong Kong, but has a China domestic orientation. The second bucket that we're looking for, recovery, where businesses have been very, very significantly impaired by the crisis. And leisure and travel would be a very, very good example of sectors of the market which were sold off very, very significantly. And we've been looking to build positions in those companies which are set to see a recovery in leisure and travel spend. One example within the portfolio would be Booking Holdings, which is a US listed company effectively providing online travel bookings in terms of airline transportation, but also hotel and restaurant bookings, which was extremely heavily sold off at the peak of the crisis. And the third area of opportunity is really momentum, where we see a continued momentum in some of these long-term structural trends that were already very apparent before the crisis. That would be typically in areas such as digital infrastructure, cloud computing, remote working, really the digitization of the economy. And there again, we have very, very significant representation in companies like Adobe, which is a US listed software company. You will know Adobe from their PDF software, but Adobe have a suite of software programs which enable the digital economy to thrive. Programs and software that will allow small to medium-sized companies to publish their brochureware online and to maintain a very, very visible presence in terms of online marketing and communication. So just three areas how we're thinking about opportunities today. With that, I'll hand back to Ashwin and thank you very much for your time.
Thank you so much, Gavin. Shane, over to you. Maybe we can open it up for questions now.
Yep. So,
actually, sorry, before that, Shane, if you can go ahead, I'll just touch upon a couple of points about the local fund. One thing that everyone should note is because this is a fund-of-fund structure, from a taxation perspective, even though we are going to be investing into equities, from a taxation perspective, being a fund-of-fund structure, investing into global stocks, ultimately it will have the treatment of what normally how we get the treatment for debt-oriented funds. So essentially, for anything less than 3 years, it will be short-term capital gains. Beyond 3 years, it will be long-term capital gains, and the rates are appropriate. Moving ahead, if you look at the summary of the fund, the NFO dates are 4th to 18th September. As I mentioned, in NAV terms or in any transactional terms, this fund will work just like any other fund that we invest into, even in domestic equities. Just one important difference, which is in terms of the redemption cycle. So the redemption cycle will be T plus 5 in this case, unlike a normal equity fund, which works as a T plus 3. In all other respects, including in the way when somebody is investing into this product, it'll work just like how the normal local equity oriented mutual fund would have worked. So with that, Shane, over to you again. Maybe we can take up some investor questions. Yeah.
So, Gavin, thank you so much, and Ashwin, for deep diving into the strategy. And I'm sure we've been flooded with a lot of questions, and let me try and take as many as I can.
Shane, you'll have to speak up. Your voice is not.
Yeah, is this better? Yeah. Sorry. So the first question, Gavin, on the strategy front, are there any country-specific or sector-specific limits in your fund philosophy, at both at the Schroder level as well as the fund that we are investing into?
Thank you, Shane. So the short answer is no, there isn't. We run this as an unconstrained fund, where we allow the stock selection to drive sector and region. But I would not want you to think that we're not thinking about risk, our sector and region positions. So we do actually manage the risk of the portfolio that comes from our sector and regional positioning, and we will not allow that to become extreme and dominate the returns of the portfolio.
And what about currency? How do you manage currency given that you operate roughly about...
Sorry, Shane, you'll have to speak up. Just to add to Gavin's point, this is ultimately a fund of funds. So as far as investors come here into this fund, there are no individual risk limits that we need to have in our fund, because as far as we are concerned, all the money that we are raising, by and large, except for cash management purposes, all of that money will get invested into the Schroder fund, which Gavin has just spoken about. So essentially the risk limits that apply are the ones that Schroders is implementing at their end.
Right. Gavin, coming back to currency risk, there have been a lot of questions that talk about how currency risk is managed, given that you operate across 20 geographies. What would you say to that?
Yes. So currency we think about explicitly when we are thinking about the profit outlook for each individual company that we are analyzing. So for example, if we believe that the dollar is going to continue to weaken as we do, so we have a view that dollar will become weaker, we think about the implication for that dollar weakness on companies exporting from the US or importing into the US, and that shapes our view on the relative attractions of that particular company in a broader context.
Fair enough. So Ashwin, from a domestic standpoint, we've not really seen international equities and international strategies pick up quite well in India. But over the last 6 to 12 months, we've seen a lot of action from AMCs offering international products. Why do you think AMCs in India are looking to go overseas?
I think there are two factors at play here. One is, as Chandresh had alluded in his opening remarks, what we are finding is that the Indian investor is also maturing a little bit, in the sense that we are seeing over the last, especially 5 to 8 years, more and more investors getting comfortable with regular allocations to equity. And as that maturity level has come, they've become a little bit more open about trying out something which 10 years ago seemed just too complicated or too exotic. But going back to the point Chandresh was making, it's also, I think, gotten pushed along because we have become more aware of many of these high growth themes, which we are dealing with in our day-to-day lives, things like technology or e-commerce or internet, which we realize that these themes are not available to us in the local equity market. So I think because of the way the consumption basket has evolved, the kind of opportunities people are seeing in their daily lives, and combine that with the fact that, people have become more mature in terms of equity investing in the last 5-8 years. I think they've become more open to trying out global investing today as compared to 10. So we've always had products, to be frank, in the Indian market. You can question whether these were, broad-based products enough, etc. But there were some of the other products which were there, but people have become more sensitive to them. Also, I'll
Yeah.
highlight again, like what Chandresh said, for us, we have been very serious about this whole space for the last 3 years. First through the structures like the Growth Opportunities Fund, which we launched 2 years back, which allowed a 30% exposure to global stocks, or ultimately through the structure that we are now launching, which is a 100% feeder.
Right, right, right. So if you were to play the investor hat, and now that we've got offerings both on the active direct investing point of view as well as the fund of fund point of view, how would you differentiate, or what would be your three parameters to identify whether you should look at a fund of fund structure or a direct investing structure?
Yeah, I would say there, if you compare a 70-30 structure like Growth Opportunities, which has a 30% allocation to global stocks, and if you look at a product like what we are talking about today, which is the Global Alpha Fund of Fund, which is a 100% feeder, I don't think there is an obvious that one structure is better than the other structure. I think both of these products will find their own space, and that was our idea as well in Axis in terms of making both of these structures available. Let me give a couple of, like you said, what are the 2 or 3 things to keep in mind? I think for many sort of more retail investors or many of the investors who are still starting their journey into investing, uh, they may find it more comfortable to come into a 70-30 structure to ease into global investing because 70% of it is still domestic. Also, as we all know, that also is a slightly more tax efficient structure because it is an equity oriented taxation that you get when you pocket 70-30. And so, many investors who are starting, taking the first steps may find that structure an easier way to take the jump into the global markets, global investing. The 100% feeder, on the other hand, can work very well for investors who are more aware, who are probably more comfortable with the whole idea of global investing, because this allows them to really use this really well into their portfolio. Because a 100% feeder allows you that flexibility that you can use it in your portfolio to take whatever appropriate global allocation that you want to achieve in your portfolio. So in that sense, it's a very targeted product. A lot of investors who are looking for that kind of a targeted kind of a global exposure would like the feeder fund to be able to do that.
Right, right. So shifting focus to the Schroders piece, Gavin, if I could get your thoughts. You alluded to how you can identify market inefficiencies in your products through your products and strategies. All we've heard in India is
Sorry,
that,
you'll have to speak up a little more.
sorry. Gavin, just reiterating, basically you spoke about market inefficiencies, but all we've heard in India is that the international market is getting more and more efficient, and hence passives are a big component of the international investing landscape. So how would you compare, say, a NASDAQ fund or an S&P 500 fund to the Global Equity Alpha?
No, it's a great question, and there is an ongoing debate and has been over many years about whether companies are becoming more efficient or whether it's simply a weight of money chasing certain characteristics. I think you only have to look at a stock like Amazon to really see firsthand the inefficiency. So Amazon is one of the best covered stocks in the world. There will be more than 30 analysts covering that stock and giving their view on the next 12, 24 months earnings for Amazon. And yet in calendar year 2015, the share price doubled for Amazon, telling you really that the estimates at the beginning of 2015 were totally wrong, and it was Amazon's ability to surprise the market and deliver ahead of expectations that drove that outperformance. And there are many, many, many examples where the market will have to play catch up and adjust its estimates in terms of forecasting the next 12 to 18 months. And that to us is the real opportunity. Now there are attractions of playing markets through ETF funds or passively, but I would argue actually we're coming into a phase of the market where stock selection actually is going to become much more important in terms of return generation, particularly in some of those expensive areas of the market like NASDAQ, where if you're buying the index, it's very difficult to discern whether you are overpaying or paying a fair price for that exposure. We can do that at a stock level, and we will avoid stocks where we think the valuations are just too stretched. So for example, Apple is a stock that we have owned in this fund historically, but we have zero weight in the fund today because we believe that the expectations for Apple are just too optimistic, and that reflects a very, very high valuation. Similarly with Tesla.
100 plus P, that's quite a risk, isn't it?
Yeah, exactly. And similar with Tesla, which again is a stock that now has a market capitalization above the 4 largest global auto manufacturers combined. And whilst Tesla has some merits, we just don't believe that the valuation can be justified and expectations too high. So that would be my response to anybody who says that markets are efficient.
How would you rate this fund on a scale of 1 to 5 in managing cycles? So we've seen a lot of short-term cycles over the last 18 months or so. And how would you rate the ability of this fund to kind of navigate tough cycles?
Yeah, again, a really great question. So we believe that this earning surprise that we look for any stock that we invest in is the primary source of share price return. So the surprise factor, companies beating market's expectation, is the thing that we look for. And we believe that a company will outperform if it delivers surprise, irrespective of where we are in a cycle. So it doesn't matter if we're in a value, a growth, a momentum, or a quality phase of the market. This fund should always, I won't say always, because of course there are periods where liquidity drives return and fundamentals don't matter. But if we're finding companies that will surprise the market, we should outperform the market in terms of stock selection. The rotation as has been highlighted is very, very apparent in markets. The ability for the opportunistic names, the shorter term names that we own to navigate that cycle provide us another area of potential growth and resilience to the portfolio.
Shane, I'll just add, not this question, but the previous question about S&P 500 and NASDAQ. I'll also add one more point because we have seen both of those index products in the local market in the last few quarters. And one point that I would like to add is that ultimately we should realize that we are still at the very, very early stage of journey. For most Indian investors, we are probably talking about their first steps into global investing. And just talking about US as a market, US is of course the largest market, but it is not the only market. Gavin mentioned that in terms of opportunities. There is the UK, there is Europe, there's China, there's Japan. So when you're looking at global investing, as Indian investors, we say that, you don't want to be too constrained looking at only India and missing out on the wider global opportunity. But to take that one step forward, if you've recognized that there is a wider opportunity, why do you want to then pigeonhole yourself only to the US market and miss out on what the rest of the world will be able to offer you? That's where, when we were looking at in Axis, which is the first product as a feeder fund that we have to get to the market, it's a very conscious call that we've taken that a global product is probably the best product for investors, because if there is a fantastic Chinese internet stock that can give people a really good experience, then why should we only be limited to US internet stock, for example, and not buy that Chinese internet stock from a portfolio perspective? And yet the global alpha is able to make through, because the global markets are very large, very messy, and that's where the global alpha team comes into picture in terms of really prioritizing and getting us the best ideas into a common product that we're talking about here.
Yeah. So also, Ashwin, they have a very good data insights team, and in our conversations with Schroders, they've alluded to that quite a number of times. So, Gavin, how has that worked out for you? How has the data insights team been able to kind of supplement your research capability across the world?
Mm. We were probably one of the first asset managers to recognize the power of data insights, data science, more than 5 years or so ago, and have made very, very significant investment in that area. And I think we probably are ahead of the game in terms of building out that resource and buying data sets, but more importantly, the people who can come in and help us visualize and use that data. It's fair to say that over time, over that 5-year period, we have largely had to retrain ourselves to understand the power of this non-financial, sort of non-traditional form of data that gives us a different perspective. And year on year, we've got better and better and better. Today, if you ask me how many opportunities the data science team contributed to, it's probably only around 20% of the investments that we make in the fund, which are shaped in some way or other by that data science input. But the panacea, where we think we can get to, it actually can be much, much more powerful than that, and could start to shape an increasing number of the names that we invest in. The panacea is really to have a perspective on stocks ahead of the market in real time. So not being reliant on waiting for the company to report its 3-month results, but really to be able to find data that gives you a very, very strong indicator of the performance of that business in real time. That to me is the panacea of data science.
So Ashwin, there's a very interesting question that has come. So what sort of time horizon should we look at while investing in this fund? Would this be more of a wealth creation / retirement corpus type product, or should we look at it as a more short-term, 3-year kind of product?
Yeah.
What is your view on that?
Yeah. So I would say that, remember that equity markets everywhere all around the world are volatile. The markets, can go up and down, and, nothing illustrates this better than what we have seen in the last 6 months. So essentially, we would not encourage any kind of timing the market kind of a thing. Even with this kind of a product, we would say it's not at all about the fact that what global equity markets may do relative to the Indian equity markets in the next 6 or 12 months. Frankly, we don't know. I don't think anyone does. But at the whole point of this is that if you are allocating to equities with a much longer horizon, then it helps if you are able to broaden the investment universe and get access to other opportunities that can help you generate a much better experience of equities. So treat this product just like you would treat any other equity product which is domestic as well. Give it a reasonable horizon, maybe 3 to 5 years, maybe longer. Don't try to time the market. Stagger your investments if you have to. Make reasonable regular allocations, and and essentially play this as a long-term theme, not about how it may do over the next few months.
Right, right. Fair point, fair point. So, what would the currency impact be? Now, Gavin spoke to us about how they effectively look to manage currency through their
Sorry, Sachin,
portfolio, right?
speak up.
Yeah, sorry. Though Gavin alluded to how they manage currency through portfolio companies. In India, do you think currency is going to make a big impact in investor returns?
So ultimately, we are not looking to hedge the currency here. So what I mean is that when an investor gives us money, whatever money we get in rupees, we will convert that into, for example, US dollars, and use that to buy the units of this fund. Uh, Over time, the fund's NAV will change, and that change will get captured in the base currency, which is US dollar. On a daily basis, our NAV will reflect that change along with the impact of the dollar rupee rate over time. So we are not doing any active hedging of the currency. The fund is exposed to the dollar rupee movement. Um, Gavin's already talked about how they manage inside the fund, how they look at currency, rather not manage, how they look at or evaluate currency impact. From our perspective, it's about one of the aspects of global investing is to get exposure to global currencies. So we believe that through this fund, investors also have this sort of ancillary benefit where they are able to get some protection against if something happens to the rupee. Of course, that cannot be the reason for investing in a product like this, because this is an equity product. So the risk from equities is the material risk, but currency sort of complements that whole experience.
Mhm, mhm. Shifting focus again, Gavin, what is your view, or what is Schroders' view on China, given that everybody the world over is has a sour face for China? What does Schroders view China as?
Well, we view China as a pretty exciting market in which to invest, and whilst the rhetoric around US-China relations at the moment is pretty grim, to be honest, I think that doesn't diminish or disguise the fact that there is significant potential to make sensible investments in companies that will benefit from a very dynamic, growing economy, and with some, with some very, very good and improving businesses. Not unlike India, to be honest. So I think whilst we are certainly cautious of sentiment at the moment and the potential for further escalation in some of these negative policies from both parties, but principally the US, we recognize the risks of that. We are playing our Chinese exposure quite carefully, and the names that we own, we believe are not going to be derailed by an extension of tariffs or trade controls, because they are domestically orientated and have limited exposure to some of these policies that are being suggested. We believe that in the run up to the US presidential elections, particularly, the rhetoric is going to be more audible and more extreme in parts, and that once we go through the election in November, once we pass through that, then we believe that the rhetoric will certainly come down, and it's in both parties, both countries' interest to find a resolution to these issues.
Right, right. So in the build-up, you have been underweight, on China. I believe I was looking through the portfolio; it was a little underweight. So I think that's in line with your general developed market bias, isn't it?
It is. We've been significantly skewed to the US, and that's been the right place to be allocating money. The US market has, for the last decade, really been the standout area in which to allocate money. Largely a function of the industry exposure and some of those big names, the FANGs that we all know, that really have driven those returns.
Yeah. Markets have been
But that,
relatively narrow, aren't they?
yeah, no, the top 5 or 6 names have really have really stood out in terms of the share price returns, but also have been entirely differentiated because of their sales and profit growth, the margins that they deliver. So you can rationalize the outperformance of those stocks based on the fundamentals of those businesses, and I think that's important to actually recognize.
Right, right. So I'll take the last few questions here. Uh, Gavin, what's your view on ESG? Has that worked for you? We've launched a fund with you that's done very, very well. What's your view on ESG going forward?
You're right. ESG has performed very well over the last 3 years, in fact. And although one of your previous callers referenced cycles, there have been a number of short cycles. But actually, over the last 3 years, many of the characteristics of strong performing ESG companies have been highly rewarded by the market. So those would be companies with a quality bias, those companies that deliver rising returns on capital, those companies that have a stability in their revenue and earnings profile. Those are the characteristics that have been rewarded. And through the crisis, ESG and quality, defensiveness, again, were rewarded very, very significantly. Now, the question is, whether the value, the alpha of ESG continues going forward, and we believe it will. The 2 buckets that I spoke about, the core names, the opportunistic names, if you are investing in a company that you expect to grow its earnings ahead of market expectations over the next 10 years, you absolutely have to have confidence that that company is well managed and the ESG profile of that company is not going to exert any risk on that business. So to that end, finding core long-term growth opportunities is closely aligned with identifying good ESG companies. So a long answer to a short question, ESG remains important. It will be an important driver of returns going forward as well.
And just to add to that, even from an access perspective in India, I think we believe that that ESG will be quite central to taking a long-term view on stocks going forward. It is a reflection of our conviction that we launched a dedicated ESG product earlier in the year, again in partnership with Schroders. And it's also to share with everyone that we are not just stopping at that fund. We are broadening our ESG understanding, and we are making sure that ESG gets integrated into every single sort of investment decision that we make across all the funds that we manage. Essentially, as Gavin rightly said, I think if you're taking a long-term view on a company, it is not possible in today's day and age to be able to take that view without understanding how that company is governed or what are the ESG practices that the company follows for its stakeholders.
Sure, sure. Yeah, good point. Finally, Ashwin, this question, I don't know, a lot of questions have come about saying that is the NFO relevant in the current scenario? Of course it is relevant, right?
Sorry, Shane, just if you could repeat that question.
Yeah. So is the NFO relevant in the current context, given that we're dealing with COVID and we're still in a lockdown?
So
It is
I mean,
relevant. Yes.
for us, this is a long-term opportunity. This is not about as we said in one of the earlier questions. It is not about the fact that there is something uh, spectacular that will happen to global equity markets in the next 3 months. That's not why we are launching this fund today or in next month. It's about the fact that global equity allocation is something that has to start becoming a structural part of the investor bouquet. And as the sooner we start it, the better it is. So there is no right or wrong time to launch a product like this. Uh, we have launched it just as soon as we were able to get the regulatory go-ahead from in terms of the product approvals, and we've chosen to go ahead. The only other thing I will say on timing perspective is if you see the order in which we have done our products, we were very conscious that we first offer the growth opportunity side of a product to the market, which we have done for the last 2 years, where investors could get a 70-30 mix exposure into their basket. And it is now our comfort that people understand and are more comfortable with global, and we've chosen to do a product which is a dedicated feeder for this market. But otherwise, there is no real view on the timing. We're just going ahead with the launch as soon as we've got approvals to be able to do the fund.
Sure, sure. So with that, the final concluding remarks, Ashwin and Gavin.
Sorry, just repeat that, Shane.
Yeah. So with that, I think we've run out of time, and just maybe a final comment from your side, both you and Gavin.
Yeah, Gavin, any final thoughts from your side?
No, from me, just to reiterate your point, Ashwin, I think this is an important opportunity to think about global equity markets strategically. The opportunities are certainly there at a stock level, irrespective of market levels and the short-term performance. I think we can find some really good companies that can generate really strong, impressive returns. So just appreciate the time and the opportunity. Thank you.
Yeah, and from my side, I think I will summarize. Thank you everyone for joining, and I'll just summarize, maybe the top 2 or 3 thoughts in my mind in terms of how you approach a product like this. Point number 1, you're doing this to broaden the investment basket, so you're giving yourself your portfolio a chance to capture some of the really good opportunities which are beyond the Indian markets. Point number 2, you're doing that in a product which captures opportunities from all over the world, not limited to US, not limited to China, not limited to Europe. Wherever the opportunities are, this kind of a product can do that. And point number 3, the way Schroders manages this product, it's called the alpha strategy. Essentially, it's a best ideas kind of a product. So it's not about just putting the money in a large number of stocks just driven by whatever's happening in the benchmark, but essentially really doing the fundamental work to understand which are the best ideas out there and allocating into those best 45, 50, 60 ideas from all over the world, which can really generate that opportunity going forward for the portfolio. So thank you everyone for joining, and back to you, Shane.
Well said. Well said. Thank you so much. And to all distributors who've spent their time with us, thank you so much for coming on board. And we really hope to see this a resounding success. Thank you so much for your time. I have to make a few closing disclaimer remarks. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully before investing. And hope to see you sometime soon. Thank you so much for your time.
Thank you, everyone.
With
Bye.
this, I think we'll end. Yeah.
Thank you. Bye-bye.
Bye-bye.